Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. Today's Analyze Out Loud video is going to be covering part 14 of a series of articles I'm doing on the various sectors as reported by FactSet. This particular sector is the process industry sector, and if you like these videos, before I go on with the video and you find them of value, please don't forget to subscribe to our channel. We'd love to have you see all the videos that we do on an ongoing basis. But anyway, getting back to the process industry sector, this is a very interesting sector for several reasons, which I'll be developing it throughout this video here. First of all, sectors tend to contain companies that have similar attributes over time. And one of the things you'll find in the process industry sector, and I'm going to take price off this graph here and just look at earnings, you'll notice that the earnings of these companies tend to be somewhat cyclical. In other words, they have periods of inconsistent earnings growth over time. There can be dropping earnings followed by rising earnings, dropping, rising, etc. And what's important to understand about that is I want you to notice how price, as always does, follows earnings over the long run. Now, there are short periods of time where the price gets disconnected. So we have the price tracking earnings. We've got 12% growth here, but it's not been a straight line growth like you see with some companies. Now, when we look at the dividend, which is the white line on this graph, we notice a much steadier rise. Now, the company's dividend went from 69 cents. The actual regular dividend was 76 cents. They did offer an additional 35 cents in a compensation dividend. So it looks like there was a rise and then a drop. It was really a steady growth in the dividend income. What's interesting about these, I'll call them quasi-cyclical or cyclical stocks, is if you put $10,000 in Arthur Daniels Midland back in December of 1999, through yesterday's close, your stock would be worth $39,460. That's a growth factor of 10.3%. You also would have received $5,655 in dividends, so your total return was $10,000 grew to $45,000, or averaged 11% a year, and that's in comparison to the S&P that only did 3%. So even though these companies are cyclical, they can be very excellent performers over the long run. Now, there are some tricks, and one thing that I wanted to point out when you're looking at forecasting, as I mentioned in the article, I think there's some really exceptional investments here. But if I look at the analyst scorecard of this company, I do want you to notice there were several times where they missed estimates rather significantly. So when you're looking at forecasting these companies, because of their cyclical nature, they're difficult. But if these forecasts were correct, you can see that the rates of return here would be exceptional. And I also want to point out that the company has this great record of growing their dividend. Their dividend has grown by a compound annual growth rate of 14%, an average growth of 15% per year, and it's been a very steady line historically. The dividend has increased year after year after year, and then this was just a special dividend, made it look like a decrease. So these are really interesting companies to invest in. Now, the second company I'm going to cover in this video is a company in the agricultural, commodities, and mining sector. And this is a very interesting picture for a couple of reasons. Number one, I have the normal PE I just added. You can notice this is what you call real cyclicality. Earnings growth, though, is average 13.6%. Now, that's going from this point to this point. So this includes some really rather aggressive, what I'll call recovery or recovery of earnings. And this is something about cyclical stocks. Just look at what's happened to this company. You had this tremendous growth here. Look at your rate of return. I'm just going to do it kind of loosely here. You would have averaged over 32% a year from 2001 to 2008. And then from that peak, had you bought it or got, say, attracted to it, from that peak to its trough in 2008, which was only a matter of about 5 months or so, could have lost 68% of your money. And then as earnings recovered, the stock price once again recovered. So if you'd have bought it here and held it for the next 3 or 4 years, and I didn't hit the top there, you'd have averaged better than 13% a year. And then more recently, the earnings fell down and the price fell with it. Now the forecast is for the earnings to grow again starting in 2019. Now, if the stock hit these earnings estimates and it did that, it would, the rates of return would be exceptional, 28%, annualized over the next 3 years or so. Now, here's the problem though. Notice the analyst scorecard. Cyclical companies are very, very difficult to analyze. If you look at the granularity of these forecasts, you're going to see that the company has missed estimates sometimes by absolutely astronomical amounts. On a 1 year forward even, they've missed it by 40%, 200%. So when you're looking at forecasting here, you can't put much credence into forecasting. The only assumption you can make is that the company does tend to have these trough earnings, which it's in right now. Last year, earnings were $2.72, but they were up 49% from the 58% drop we had the year before. And that's the real insidious part of this. But now we're looking at estimates of 47% growth and 28%, if you can believe those estimates. Regardless, if you look at the long-term track record, even with all that cyclicality, if you bought this stock as far back as you can go, August of 2001, you would have earned $9,400 in dividends versus $33,989 in the S&P. 10,000 would have grown to 29 versus 23,000 and change. Your total would be 38,000 versus 27, and 8% return versus 5.9. So again, we have an extremely cyclical company here that's had very poor performance for the last couple of years. And in spite of that, and considering that the overall stock market is actually overvalued today, it has outperformed the market over this long-term history. The question is it something you should be buying today or not? So let me go ahead and move on. I want you to get the flavor and the feeling of these companies. They're cyclical. And what's happening with cyclical companies, and can happen with cyclical companies, once they have some down years, and this is Cabot Corporation, an industrial specialties company, and you can see again the relationship between earnings and price. You get overvaluation that reverts to the mean, overvaluation reverts to the mean. You get price tracking earnings down during the Great Recession. But then look what happens after the Great Recession. Earnings went to 16 cents from $1.47. This has a September fiscal year. So in September of 08, the company earned $1.47. They had earned $2.22 in 87. So we had negative growth of 34%, negative growth of 89%. But then once we got down to this low base of 16 cents, you can see the company has innate earning power of $1.50 to $2 or so. Earnings kind of go back to normal or even above. Earnings go from 16 cents to $3, and we get this tremendous surge over a couple of years in valuation where you'd have actually annualized for 2 years there and almost 100% a year returns on your money. Then earnings kind of flattened, and again, we have kind of flattened stock prices. Now we have earnings rising again. The stock price is currently undervalued. So if we look at performance over this time, even though the stock is undervalued, it still generated more dividend income. And in this case, you have a proverbial tie with the market. Total return just slightly under the market, even though you got more dividend income. But the point is, if I look at forecasting graphs, and this company does grow at 10 or 12% a year going forward, you've got a chance of making stellar rates of return over the next 2 or 3 years. But once again, can we trust the analysts? And if we look at the analyst scorecard on a 1 year forward, you can see that they've missed it 40% of the time. And sometimes those misses were rather large. 50% miss here. We only had a 1% miss here, and that considered a hit because we give them a 10% margin of error. But the point is, as you look at historical data, I want to make this clear, when you get these earnings growth, you get really nice rates of return over the short run. So the next company I'm going to go to is Eastman Chemical Company. Now here we have probably more growth and less cyclicality. Now again, from point A to point B, and that includes a couple of years of forecast, we're looking at a 12% growth rate. We can see the price has tracked that. If I go ahead and look at performance here, you can see that the company generated substantially more dividend income than the market. It also generated significantly more growth in the market, 6.6% average annualized rate of return of growth versus 3.9. So you end up with an 8% return versus 4.8. So once again, we have outperformance. We have forecasts for about 8.5% growth going forward. Because this company is a little less cyclical, I do want you to notice the analyst scorecard here is a little better. The company still missed estimates 20% of the time in a 1 year and a 2 year forecast. But the point being is you might have a little more confidence that these estimates might be closer to actuals, to actually happening than we saw with some of the others. But once again, if it was true, you have a 90+% gain potential if the stock moves back to a 15 PE ratio by the end of this particular fiscal year. You could average 41% a year through 2020, and even if we go out all the way to 2021, you could be averaging 29% annualized rates of return. So, you're looking at a company that is undervalued that could generate some really significant returns going forward based on that continued earnings growth. Now, the next company I'm going to look at is FMC Corporation. It's again a chemicals and agricultural company. And once again, notice how, we have this really great relationship between earnings and price. The more consistent earnings growth were, the more highly correlated the price was to those earnings. But then we had this big drop in earnings, a 39% drop in earnings in 2015, and the price followed that. Then we had a flat year, but then once again, when you have these down years of earnings with these cyclical companies, you get these huge increases. We all of a sudden have 130% growth. And just imagine, you've got about 7 or 8 quarters going on here, of which you probably had some really, actually 3 or 4 quarters of some really excellent reports here, and that of course gets the market excited. So we have a short-term gain here averaging 36% annualized over, I guess we'll call it just a little slightly less than a 3-year period, but that's coming off a recovery because we have this huge gain in earnings growth because the company was again coming off a low base. When I look at the long-term performance here, once again you see significant outperformance in dividends. You see actually really substantial outperformance in growth. 10,000 grew to 146,000 versus 22,000 in the market. This goes from November of 1999. It's a 15% return versus a 5% rate of return. Point is, you had significant undervaluation here. You had some down years in the markets, and now we're kind of back to fair value, but we're expecting, some really excellent growth going forward. The forecasts look for about 11 or 12% growth over the next several years. So once again, you've got an opportunity here to make strong double-digit returns over the next several years. My next company is Ingredient. It's a commodities milling company. 2.6% dividend yield, 43% debt, BBB rated. Look at the price and earnings relationship. Look how when price gets well above the earnings line, it becomes vulnerable. And then we have a down year of earnings and we get this, huge collapse in stock price. From 2018, we see a 35% drop in the stock price here. But now, once again, we're starting to look at forecasts for some decent growth going forward, which means you could make, if you get a reversion to the mean, you could make 19 or 20%, 13, 14%, 11 to 12% rates of return over the next 1, 2, or 3 years in this company, mainly because what we're seeing is a moderate recovery, but we're seeing an undervalued stock where we go from a PE of 13.6 back to a normal or a more practical PE of 15. We have a very excellent dividend record. Our performance on this stock once again dramatically outperforms the S&P over the long run. This goes back to November of 1999 again. So you can see that even though these stocks are cyclical, they have excellent dividend records. Here we have a 2.6% dividend growth rate, but you have to be willing to go through these ups and downs with these companies. I think that's one of the main points I'm trying to make here. My next company is International Paper, highly followed. It has a very high yield, only a 9 PE. Not a lot of growth compared to the other stocks we looked at, only 6% growth. And again, look at the cyclicality. The company's dividend was virtually flat for all these years, going from 2000 all the way through the Great Recession. Then they slashed the dividend dramatically to 33 cents. And then coming out of the Great Recession, they started raising the dividend again. And during the last several years, their dividend growth has been stellar. So if I, shorten this to a 10-year graph, you can see that their dividend growth has averaged about 10%. And the company's performance over this time has tracked earnings very nicely. The allure here is a 4% dividend yield and a very low valuation. That's the key. So if we go back to a 15 PE, we double our money this year, even though earnings are expected to drop by 20%, and the drop by another, or by 2%, excuse me, and drop by another 1 3/4 to 2%, we would still be making 35% returns. And then if I go all the way out to 2021, it would be 20% returns. And that's based on the valuation going back to a 15 PE. And again, if you look at this historically and look at even the longer term historical rate, you can see that the orange line here is a 15 PE. This stock is traded at a 15 PE or higher a significant portion of the time historically. So it's not a stretch to think that it might go to a 15 PE going forward. Anyway, let's move on to our next company. Here we're looking at Basil Industries. It's a chemical specialties company. Got a real short history here. We've got moderate cyclicality. It's not super cyclical. Let me get rid of that negative number. It's averaging about 10% growth. If I look at performance over this time, it's underperformed underperformed the market in growth, but it's outperformed it in dividend income. But again, it's undervalued today and the market's overvalued. Looking at forecasting going forward, we're expected to have a down year this year, which I think partially explains the low valuation, followed by 14% growth the following year, followed by 3%. It's that historical nature that really, I think, gets these companies, hard to invest in. Now, this company has an excellent analyst scorecard for this short period of time. You can see the companies either they've beat estimates the vast majority of the time, or they've met or they've hit the estimates within the margin of error. So this is an interesting company with a good valuation, a 4.4% dividend yield. Its dividend growth record has been excellent. So the point is, even though it hasn't outperformed the market over this time frame, the market's overvalued. This stock is undervalued. It has a great dividend record, a much higher yield, and if it gets back to just its normal PE ratio, looking at forecasting, which is only a 9 PE, you still have the ability to make double-digit returns here. So this is an interesting company to look at, I think, currently, with a good yield and a good, historical record, even though because of its undervaluation, it hasn't outperformed the market. Here's Packaging Corp of America. I'm not as crazy about this one, but the statistics look good. A 12.6 blended PE, 3.1% dividend yield, less than 50% debt. It has a decent dividend record since coming out of the recession, although they did cut the dividend in half during the Great Recession. If I look at long-term performance, once again, we have outperformance of the market. Once again, considering that this stock is currently undervalued, the market's overvalued. There is a thread of cyclicality here that I would bring your attention to. So when you're looking at forecasting, there is going to be some potential bad news, in the foreground here as we go forward. So I'd be careful with this one. But again, it's got good stats, 3% yield, 12 PE. This could be an excellent time to buy this stock, at least for the next year or two. Now we're going to move on, and we're going to go to Westlake Chemical Company. This is a major diversified chemical manufacturer, very cyclical. If I look at long-term performance, it's outperformed the market on dividends, dramatically outperformed it on growth and total return. Again, it's undervalued today and the market's overvalued, but I do want you to notice this stock usually trades at about a 13 PE. So when I'm using forecasting, I'm going to look at the 5-year normal PE ratio as my benchmark and not a higher 15 PE ratio that you see. So I've got a 13.2 PE ratio. That would still mean 25% this year, even though earnings are expected to be down, annualizing at 26% a year out to 2020, and annualizing at 18.8% out to 2021. So this is a company you buy at a discount. It doesn't have much of a dividend yield. It only has 32% debt, but it's definitely undervalued based on its normal PE, and we are expecting, and this is the key, we are expecting some pretty substantial growth going into 2020, and that's when, as you look at these stocks, when you get these spurts of growth, that's when the performance on these companies gets really attractive. Now, my next company is Westrock Company. It's a container and packaging company, and again, what I really want you to focus on, when you have down years of earnings like you have right in here, they are often followed by these huge surges in growth, and when you get these huge surges in growth, you get these really high valuation. The stock is yielding 4.6%, has a PE of 9. If you look at its long-term track record, it's dramatically outperformed the S&P on all counts, growth, dividends, and total return. The stock is undervalued significantly compared to an overvalued stock market. Forecasts are for rather flat growth for the next couple years, but if it just reverts back to a 12 PE, you've got a chance to make significant rates of return. Its scorecard is credible. It's not as good as we saw a minute ago, but the one-year forecast, they only miss 30% of the time, but they do miss half the time on the 2-year forecast. So the further out you go here, maybe the less credit you might give to whether these forecasts are correct or not. But anyway, this is an interesting company that's very undervalued. Now, finally, I've saved perhaps my favorite company in this group for last because there's some really interesting stories here and some really important lessons on valuation. We've got moderate cyclicality here, but this company is a major lithium producer. And once lithium, and the Green Deal and the Tesla automobiles with the lithium batteries and, lithium just being such a high demand product, I want you to notice that how price tracked earnings all these years. And then in 2017, 2018, 2019, and expectations for 2020 are for some really nice growth. You can see the earnings line going up dramatically here from its, again, coming off a low base. The stock price, though, had this huge surge from being, moderately undervalued to overvalued. There was a couple of years there where you'd have averaged annually 75% a year, more than doubled your money in 2 years. But then we see the stock being massively overvalued, and then we've now, since that time, we've had a nice reversion to the mean. From peak to trough here, the stock has fallen about 43% in the last year, year and a half or so, but is now attractively valued with a PE of 15 and a dividend yield of 1.7. It's forecast to grow at 11 or 12% a year. So even if I'm utilizing normal multiples or the fair value multiple of 15, this company has the ability to offer 12 or 13% rates of return. And even though its analyst scorecard is not stellar, they miss half the time, the thing I would say about this company, because of its lithium production, really has an opportunity to grow very nicely over the future. So I think this company is really attractive based on the potential for lithium going forward. So I would give Albemarle a quick look. Now, I wrote about this company. It was overvalued and talked about how dangerous it was at that time. You can check my YouTube channel and find the video I did on it. But now we've had this reversion to the mean and the stock looks attractive. Anyway, this has been Chuck Carnevale saying thanks for watching. I really like this sector. I do own investments in this sector. It's cyclical, but sometimes cyclicality can be really beneficial to your long-term returns as long as you're willing to ride through the ups and downs that cyclical stocks tend to bring. Thanks for watching.